We're here today to launch our first bi-monthly report for 2017, focusing on trends and transactions in all sectors of the Irish commercial property market. Following an exceptionally busy year in 2016, the momentum has been slow to build in the opening months of 2017, with few large assets launched for sale and not a huge volume of transactions being completed during January and February. While this is somewhat normal for the time of year and masks considerable activity behind the scenes, particularly on the development front, at this stage it appears that the bulk of transactional activity in many sectors of the market in 2017 will occur in the second half of the year as opposed to the first half. We expect to see a meaningful improvement in activity in the Irish commercial real estate sector over the next couple of months, assuming sufficient product comes available to match underlying volumes of demand. In the office sector, following a dearth of transactional activity since the beginning of 2017, there has been a notable increase in demand for office accommodation over recent months, with several new requirements having been activated since Christmas. Occupiers with active requirements at present include Facebook, AIB, the IDA, New Relic, Allergan, Eversheds, Indeed, WeWork and Huawei. Many of these requirements are unlikely to translate into completed leasing transactions until at least the second half of the year. In addition to these requirements, a number of Brexit-related inquiries have escalated since Theresa May's Brexit commentary in January, which appeared to suggest that going forward, passporting may not be an option for some of the UK-based financial companies. There's been continued press speculation in recent weeks about financial services occupiers focusing on the impact Brexit might have on their operations and looking at locating some jobs in locations such as Dublin. It is not clear at this juncture how big these requirements will ultimately be and what the likely timing might be, but it is increasingly likely that Dublin will benefit to some degree. Buoyed by a healthy pipeline of demand, Ballymore Oxley has now confirmed plans to commence construction on 3 further office blocks at their Dublin Landing scheme in Dublin North Docklands, delivering an additional 330,000 square feet of office accommodation on this site by the end of 2019. Adjacent to this scheme, the Central Bank of Ireland is now in the final stages of fitting out and moving staff into their prestigious new headquarters building. There are now 27 office schemes under construction in Dublin city centre, totalling more than 360,000 square metres between them, with 20% of this stock already pre-let. Pre-letting has really re-emerged as a trend in the Dublin office sector, having accounted for almost a quarter of office leasing activity in the capital in 2016. This trend will continue to dominate in 2017, with several occupiers comfortable signing pre-leasing deals on many of the office schemes that either have a grant of planning permission or are already under construction in the capital. Prime office rents in the central business district of Dublin are now stable at €673 per square metre, although we have seen some upward pressure in prime rental values in the suburbs of the city over recent months. From this point forward in the current cycle, we don't expect to see a large number of new planning applications for office accommodation being lodged, considering the volume of office stock that is already under construction in the capital, and indeed the number of schemes with a grant of planning that can be delivered if demand materialises in due course. In the industrial and logistics market, just as in the office sector, the volume of take-up has been relatively subdued since the beginning of the year, although the low volume of transactions signed during January and February is normal for the time of year and masks the volume of underlying demand and activity in this sector of the market. As has been the case for some time now, the biggest challenge in this sector is a severe scarcity of modern industrial and logistics accommodation, with speculative development still remaining largely elusive. In turn, the shortage of modern stock is leading to some strengthening of landlords' terms in lease negotiations. There have been some strategic land acquisitions completed in recent months. There's also activity on various industrial schemes, with a number of planning applications currently in the planning process. However, we don't expect to see a meaningful improvement in speculative development in this sector until such time as rents rise a little more. Prime rents in the industrial and logistics sector are now in the order of €94 per square metre, but are expected to increase by almost 14% during 2017, at which point development will once again be viable. In the interim, potential occupiers will continue to pursue build-to-suit options, and we expect to see continued demand for any large-scale premises that are offered for sale or to rent, as demonstrated by the appetite for the recently relaunched former Electrolux premises on the Naas Road in Dublin 12. Another property that has recently been launched for sale and which is likely to attract considerable interest is the former Merck Sharp and Dome facility in Swords in Dublin 9, which is guiding in excess of €25 million. The Dublin data centre co-location market achieved very impressive take-up last year. Indeed, Dublin ranked third in the top 5 European data centre markets last year, with higher volumes of take-up recorded compared to Frankfurt or Amsterdam. We've witnessed continued strong demand for data centres since the beginning of the year, and we do expect this trend to continue. Industrial and logistics buildings only accounted for 2% of investment spend of assets of more than €1 million in the Irish market last year, as a result of the much highlighted challenges in sourcing large-scale investment opportunities in this particular sector. However, by virtue of the fact that the industrial sector is anticipated to generate the highest rental uplifts in the Irish commercial property market in 2017, there has been a notable increase in investor appetite for industrial investment opportunities of late. The retail sector of the Irish economy also remains robust, buoyed in particular by continued job creation, strong tourist activity and demographic changes. An increase in residential construction, albeit from a relatively low base, has also started to benefit the sector, with improved occupier interest in retail park schemes being reported over recent months. Since Christmas, demand for suitable floor plates in many of the prime pitches continues to increase, with the biggest frustration continuing to be a scarcity of premises to accommodate the many retailers looking to source stores, as was clearly evident at the recent Completely Retail event that was held in Dublin. Food and beverage retailers remain particularly active. Unlike other sectors of the market which are experiencing an increase in development activity, most projects that are underway in the retail sector of the market comprise extension and refurbishment programmes as opposed to new builds. An extension project is now underway at Frascati Shopping Centre in Blackrock in South Dublin, while on Dublin's Henry Street, work has begun on the refurbishment and the addition of 5 new units at the ILAC Shopping Centre. Work is currently underway on the refurbishment of the City Square scheme in Waterford, and an extension to the Ayr Square Shopping Centre in Galway has now complete. Construction has also now commenced on Gorey Retail Park in Wexford, with Iceland, Eurogiant, Maxi Zoo and Costa Coffee confirmed as occupiers. Meanwhile in Cork, work is now nearing completion on the Capitol Cinema site in the city centre, while in Dublin there's good interest in new retail accommodation that is being developed by Green Reach on Dawson Street in the city centre. An ever-increasing proportion of Irish retail spend is now occurring online, as evidenced by surveys such as Visa's recent Irish Consumer Spend Index, which showed a 12.3% increase in online retailing over the last 12-month period in Ireland. We're now urging government to start formally tracking online sales activity, as current measures of retail spending in the Irish economy fail to capture a significant proportion of retail activity by virtue of excluding online purchases. With concerns about the leakage of retail spend to Northern Ireland and indeed to UK websites as a result of sterling weakness continuing to prevail, the need to have access to comprehensive data on Irish consumer spending patterns, both online and offline, is becoming more pressing. In the investment sector, the recently released MSCI index for Ireland confirmed that total returns in the Irish commercial property market last year reached 12.4%, an impressive rate of return, albeit exactly half the total return achieved in the previous 12-month period when the Irish economy and the commercial real estate sector was firmly in recovery mode. The Irish market remains attractive to investors and is well supported by the underlying strength of occupier markets, which is continuing to drive rental improvements in all sectors. However, the pace of total returns has slowed in each of the last 8 quarters as the Irish commercial real estate market reverts to more normalised trading levels. Last year's record €4.5 billion of investment spend is unlikely to be matched in 2017, now that deleveraging activity has slowed and in the absence of any significant trophy sales which were prevalent in 2016. Appetite for prime investment opportunities has intensified noticeably over recent months, with international core capital remaining active buyers, which could actually lead to some further hardening in yields for prime high street and prime office assets in due course. However, a heightened perception of risk has negatively impacted demand for secondary assets of late, which could actually have the opposite effect on pricing for such assets as the year progresses. The biggest frustration in this sector of the market at the present is a scarcity of prime product to satisfy investor appetite, considering the dearth of opportunities formally launched for sale during January and February. However, this is expected to change over the coming months as we move towards the traditional selling season and momentum picks up. We have noticed an increase in the number of private investors bringing assets to the market for sale over recent months, which should help to alleviate pressure to some extent. As we pointed out in our recent Outlook 2017 report, we're seeing a notable increase in investors seeking forward funding opportunities and also looking for investments in alternative sectors. Indeed, investors the world over are increasingly becoming agnostic about what specific sector they're targeting and focusing more on long-term income generation potential in a myriad of new sectors such as PRS, purpose-built student accommodation, hotels and healthcare, a trend that we're definitely witnessing in an Irish context. Demand continues to outstrip supply in the development land sector also. Although several infill sites continue to sell, some of which are trading off-market, there are very few sizable land parcels being formally marketed for sale. This is at a time when there is severe supply shortages in many sectors of the Irish market, most notably in the residential sector, with house prices nationally having risen by more than 8% and rents nationally having risen by more than 13.5% during 2016 as a direct result of supply shortages. Where land is coming available, there's strong demand, particularly for well-located sites that have viable planning permissions. We're seeing particularly strong demand for residential sites in Dublin's commuter belt, with developers encouraged by an increase in mortgage applications and the volume of sales being recorded at various new home scheme launches over recent months. Specialist operators in the PRS and student accommodation sectors are particularly active at present. We're also seeing good demand for well-located industrial land along major road networks. We understand that RTE will shortly launch the sale of approximately 5 acres at their Montrose campus in Dublin 4, which is certain to generate strong interest. We expect to see a number of other semi-state organisations making decisions to bring land holdings to the market over the course of the next 12 months, considering the current appetite for well-located sites in good locations. We believe that we're beginning to see a meaningful improvement in the delivery of new housing stock, albeit coming off a very low base. According to the latest government figures, 14,932 new homes were delivered in Ireland last year, up 18% on the previous year. Of these, 6,289 were built in the Greater Dublin area. This remains well below required volumes, but it is a step in the right direction, and it will be boosted by the delivery of much-needed PRS accommodation in due course, which has the ability to deliver scale in a relatively short time frame. 2016 was a record year for Irish tourism, with tourist numbers up 11% year on year to reach almost 9.5 million visitors. On the back of this, the Irish hotel sector performed extremely well, as evidenced by various performance measures, which recorded impressive year-on-year improvements in measures such as occupancy, average room rates and RevPAR in hotels in all of Ireland's major cities last year. Last year also saw record transaction volumes in the Irish hotel property market, with 66 hotel properties having traded in the calendar year, excluding those that traded as part of loan portfolios or indeed as investments. Following this surge in activity, which was heavily weighted towards the latter half of the year, transactional activity during the first 2 months of 2017 has been low in comparison. Indeed, the 104-bedroom D Hotel in Drogheda, County Louth, and the 30-bedroom Clifton Court Hotel in Dublin city centre are 2 of only a small number of hotel properties that have actually changed hands in Ireland so far this year. The market is very busy behind the scenes as assets are being prepared for sale and other sales processes are being conducted off-market. However, very few hotel properties have been formally launched for sale so far this year, which is frustrating considering the weight of capital chasing opportunities at present. The focus in the Irish hotel sector has now clearly moved towards development, with a notable increase in planning applications for hotel projects over recent months. Although there are a number of large schemes with a grant of planning permission, getting these projects on site continues to prove challenging due to the scarcity of development funding for hotel development. This seems counterintuitive considering the demand for hotel accommodation in cities such as Dublin, Cork and Galway. As a result, we expect to see specialist lenders focusing more intently on funding opportunities in this sector during 2017. We also expect to see increased evidence of forward funding as the year progresses. It now appears that only approximately 200 new hotel bedrooms are due to come on stream in Dublin during 2017. It will therefore be 2018 before there's a meaningful improvement in supply in this sector, with somewhere between 1,200 and 1,500 bedrooms scheduled to complete and open in Dublin next year. In the meantime, we expect to see hotels continuing to perform well, as evidenced by the latest SDR numbers, which show Irish RevPAR up 9.5% in the month of January. In summary, with the market slow to kickstart in 2017 and many assets only now being officially launched for sale, it seems certain that transactional activity in most sectors of the Irish commercial property market will be heavily weighted towards the second half of the year.